Good morning. Driving to work and want to talk to everyone about financial freedom. It's something many strive for. I say that's why we get up and go to work, provide for our families, and make a better life for ourselves, and also give back to our community and work with helping others. Anybody can have financial freedom at different degrees. I want to bring something to you about financial freedom and something that I can work with you on to show you how to start creating financial freedom in your life. Majority of Americans save less than 10% of their annual income. Some don't save any at all, living paycheck to paycheck. And we've probably most all been there at a time in our life. But it doesn't have to be that way. And I work with different insurance companies, and one of the insurance companies that I work with is a mutual insurance company, and they offer life insurance and many other financial products. When we think of life insurance, we're thinking about, okay, well, I want to pay as little as I can monthly or annually to get the biggest death benefit I can. That's typically your term insurance. The type of coverage that I want to talk to you about and put it in practice in your life is a permanent insurance plan. It's a permanent coverage, and it has great living benefits for you, your family, and your business, depending on how we structure that plan. Those living benefits are, as you pay your premiums into the policy, we add paid-up additions onto the policy contract for you, which is built in when you're paying your premiums, and it goes right into basically put more money in the cash value side of your policy in the early years of the policy. This faster cash value accumulation is your money, and if you need to borrow the money or access the money, you have that ability through the insurance carrier. We use a mutual insurance company in setting this up due to the fact that they're very conservative. They have a board of directors typically. They don't have shareholders or to answer to stockholders, which they're obviously looking for profits, because they pay dividends to all their contract holders, and which policy holders are owners of the company, because you own the contract in the mutual insurance company design. When they're paying dividends, these dividends can be substantial depending on how much you contribute into the contract with the company, contributing to the contract in the form of your premium payments. And in those premium payments are where we set up your paid up additions. Really, we overfund the contract, which is the way we do this by design, which builds the cash values. If you need to borrow money from your contract, this is where you go. Every household should have this as a savings account for them, because it's got a death benefit, because it is a life insurance contract, so it has a death benefit for the beneficiary that grows as your cash value accumulates and grows. And again, as the cash value accumulates, you need to save $50,000 to go buy a car or do something with. You call the insurance company, take a policy loan out, and the policy loan the carrier gives you is backed 100% by your cash value or your death benefit. You buy the car or whatever you're buying, and you recapture the cost of the car or whatever the money you're spending on, because you're going to pay it back to your contract, and you want to pay it back to your contract with interest. So the first part of basically the savings and starting to get you some financial freedom is saving in this contract by paying your premium payments and building that cash outlay in the contract. as soon as your cash outlay is built up enough to make your first purchase in your family that you need, or your business, or your just life, you do that. You pay it back into the contract with interest, because you want to pay interest to yourself on your own money, because it's going to grow that much faster for you, so you can do it again and again and again. And the growth in the contract as you do this can be pretty substantial. Now, later on in life, if you want to pull the money out, and the way we explain this, you pull the money out when you retire, when you get older, you don't pay it back. It's not a taxable income either, because it's in an active life insurance contract that you're pulling the money out. So you're pulling the money out, $50,000 a year, for example, $75 or $100, depending on the cash accumulation we've set up in earlier years to build throughout your life. Whatever that number is you pull out, it's 0% taxation as long as your contract is active. You're not even taxed on the growth inside the contract, because it's an active life insurance contract, permanent insurance, a living benefit in the contract. 401ks and these other instruments they're tax deferred, but the problem is you're going to pay taxes down the road when you start pulling the retirement money out of those contracts. We're here, as long as you keep the permanent life insurance active, which that's the whole plan, the money you're pulling out are not taxable. They call it tax deferred in early years. They tell you that due to the fact if the contract cancels, yes, if you cancel the contract, the growth in the contract over what you contributed into the contract is a taxable consequence at that time. That is taxable. You can start this on a small scale, just a small amount monthly into the contract. If you're financially able to put more into the contract, you'll see once you see the design is always for the cash to grow and the death benefit to grow, because they know they're going to pay out a death benefit at a future time. It's got to grow and perform to do that. We can set this up or go over this. I can go over this with you in further discussion and go over the concept, but it really just comes out of another way of thinking and starting to put your money to work for you, and it's working all the time in this contract. When you pull the money out also, or when you basically put the money as collateral, go to the insurance carrier and say, hey, I need $50,000 or whatever amount of money based on your cash outlay that you have in cash accumulation. And when you spend the money, the insurance carrier is still paying you your annual dividend payments as the full value of your contract. They don't deduct $50,000 in value because you took a loan out from the carrier, or $100,000. That's a great benefit in these type plans, insurance contracts. The dividends are still rolling in. So, once you learn this concept, you really don't want to spend any money except what you build up in the contract, because when you spend that money, you're still getting paid dividends into the contract for it to grow. Where standard bank account, where you have your money or savings, you spend it, it's gone. You're not getting any dividend payments or any reward paid back to you, which today it's hard to even find any kind of accounts that pay any kind of interest to you. I can go more and more in depth with this. We could do I can do a video with you, or a webinar with you, and show you how this works in a contract design. Remember, it is a insurance contract. It's a permanent life insurance contract, but it has to be set up the right way, and you need somebody that's been trained in this to do this for you, and can go over it with you. For business owners, we can set this up also as an exit strategy for the business owner. Most people do not have I find out in small businesses to medium-sized business, they don't have an exit plan out of their business. They want to sell it, but it's hard sometimes to find buyers, and you might have somebody right in your own organization that is a perfect fit, and I can show you how to transition out of that business down the road, but we have to start planning now. Best time to do this was yesterday to get this set up. Next best time would be today, because it's based on actuarials with age and different things. So, and tomorrow is not promised, and the next hour isn't promised. So, we want to get this set up for you, get it working in your life for you, your family, your business, and so you can take that next step to financial freedom. I also have a book that I'd be glad to share with you, loan to you, anyone that would like to read it and learn more about it. But thankfully you got me, so I'm your book for now. Look forward to hearing from you. You can message me, and I'll have an email and contact information as well. Thanks for your time this morning. Make it a good day. Bye-bye.